All right, welcome back for another video. Today we're going to be talking about the S&P 500 and ETFs and what exactly they are and why you should invest in. So, a lot of people don't exactly know what an ETF is and they don't know where to get started with investing. An ETF is an exchange traded fund. It tracks a certain sector. So, you hear about mutual funds, you hear about index funds, you hear about ETFs. So, an index is a certain sector of the market. It's going to track certain stocks in that sector. An ETF is actually going to track that index. So it's if you want to be in the technology sector, it's going to track all stocks in that sector, and each ETF is going to have its own rules and guidelines, distribution structure, payout structure, whatever it is. It's also going to have a expense to it. ETFs typically have a lower expense. You'll hear that a lot when people argue with Dave Ramsey on mutual funds, right? He uses mutual funds that outperform the S&P 500. The S&P 500 is the Standard & Poor 500. It's the top 500 stocks in America, USA. Typically, top 500 stocks in the world, but that happens to fall pretty much in the United States. So that's why we say that. So in the last 5 years, the S&P 500 has gone up 80.66%. Don't worry, I did the math for you. That is on average 16.132% per year on average. So some years it might have been up, some years it might have been down. That is what it is. You can see right here between 2022 December 31st and 2023 December 31st, we were actually down. So it's on average. Averages are what is key when it comes to ETFs and passive style investing. I did a video on the top individual stocks that I picked for the year, and this is going to be a video on my top ETFs and how to find your own that's related to what you would like to invest in and a way to be able to track it. So once again, we're using Fidelity. Fidelity is just the winner when it comes to ease of access for me and what you can actually learn by just looking at their overall home screens, their charts. I enjoy Fidelity. It's what I use personally. So right here, we're going to start looking at some of the more common ETFs that people can find. And that's going to be the VUs, the SWABs, the SPY, the QQQs. You'll hear these all over the internet, and we're going to go through a few of them. We're just going to take a look at them. I'll explain a couple of them, and then we'll just look at some of the differences. So right now we're looking at VOOV, which is the Vanguard S&P 500 Value Index Fund ETF. So it is an index fund ETF. And we're going to look, the expense ratio is 0.07%. Once again, very low expense ratio. You'll see videos of people talking about how the expenses can outweigh the actual gross profit, and it actually can cut into your profit margins. But with this low of an expense, it's not a big deal. But you need to look at it before you actually start investing it. So we're going to look right here, the top holdings. You got Apple, Amazon, Exxon, Walmart, Tesla, but Apple makes up 7.39% of the entire ETF. Amazon makes up 3.88%. Now, what that means is for every one share of this ETF of VOOV that you own, 7.39% of that share is going towards Apple, 3.88% of that share is going towards Amazon. So in reality, you got $210. We're going to clear that out to 10 to make it easy. And we're going to times by 0.073. So you're roughly $15.33 is going to actually be in Apple. So this part is important because you want diversification And that's exactly what an ETF gives you. It gives you diversification across a certain sector. So, in reality, with that being said, you have Apple here, right? And you might think that, okay, well, I have this ETF. I want more diversification, right? I don't want all my eggs in the same basket. Now, when you look at the others, you're going to see we go to VOO, which is Vanguard 500 Index Fund ETF. It has a lower expense ratio, higher cost per share, but its number two holding is Apple, once again, at 6.86%. So if you go into both of these ETFs, you're double dipping on Apple, right? So that's where diversification matters, but you also need to pay attention that your ETFs don't overlap extremely to an extreme amount. You want to have the diversification. This one, the top 10 holdings are your typical um, tech sector stocks, plus you got Berkshire Hathaway in here as well. But the rest are going to be the tech sector because they are the leading in the S&P 500. We call them the Mag 7. They're across the board the highest valued companies in the S&P 500. But what that also means is that if you use ETFs that track the S&P 500, you're going to be double dipping in the same stocks over and over. So if Apple crashes, then both of your ETFs are going down pretty significantly, right? So we're going to move on from that. Out of the, I like the VOOs. I really actually do like the VOOs. They're great for tracking the S&P 500. But where I'm going with all that is you only need one, and you just do a little bit of research and see what holdings they're actually in. So if you want to be across those Mag 7s, then VOO is better than VOOV because you only get a few of the Mag 7 in your top 10 holdings. So we're going to move into some of my favorite ones, which are the actual Schwab ETFs. So you got SCHD. SCHD was a huge craze for the last couple years. And it's got a lower expense ratio at that 0.06%. It's kind of in the middle of those two VOOs. And when you look at what they actually hold, they hold dividend paying funds, stocks. So every holding in SCHD will pay out a dividend. When you're looking at your current distribution, you got 0.2782 cents per share or 3.62%. Now, what I like about SCHD compared to the others is I'm a dividend lover. I just love dividends. They're paying you to own their shares. You're a part owner in their company. So they're cashing you out on it every single month, quarter, year, whatever their dividend payout is. And to me, that's just fantastic because if you reinvest that dividend back into that fund or that stock, then the amount of shares you actually own increases and then you get paid more dividends. And it's just another amplification of how many shares you own, which is just fantastic. One thing that I kind of forgot about was how it performed against the S&P 500. So SCHD total returns in the last 5 years was about half of the S&P 500. But once again, you also have that dividend compound in there, which will actually increase it quite a bit. VOOV was at 12.86, which was under that 16% on average. VOO was at 14.4. So if you're looking at you want to compete with the S&P 500 just across the board, out of those three so far, I would recommend VOO. And then like I said, I have a thing for dividends. I don't know what it is. I just love the fact that they're paying you out to own their shares in their company. So now we got Schwab US Large Cap Growth ETF. This is another one that I like. It's large cap, but it's growth. And if you look, you got the Mag 7 once again. You do have Eli Lilly. You have a, yep, it's pretty much Mag 7 plus them. So that's in their top 10 holdings, and it's going to be 58.41% of the top 10 holds pretty much all that fund. So you're actually amplified into some of these stocks. It's a little heavier on the percentage, which is a great thing. You do have a small dividend in there, and you have a smaller expense ratio compared to SCHD. And then in their last 5 year, 15.77. That's what I like about the growth is you actually are ramped up a little bit stronger, and you actually do find those ratios, that return percentage compared to the S&P 500. And that I combine SCHD with SCHD. So that way I still have the percentage growth that I'm looking for and profits and total returns. And I'm also getting my dividends. So we're going to go through a couple more that are some of the bigger ETF players that everybody knows about. Is the SPY. That's going to be the Spider. So it's a S&P 500 ETF trust, right? You actually have a little bit higher on the expense ratio comparatively. It's still kind of low overall. And then down here, you get a little bit of a distribution yield. And once again, you got the Mag 7 plus Berkshire Hathaway. Now, Berkshire, that's going to be a fantastic stock to hold. They do great things. So I'm not going to complain about that. You got your ratings and everything, and then you have their 5 year. Their 5 year is going to be 14.34%. That is fantastic comparatively to the S&P 500. You're only down 1.5% comparatively, which is great. So I see nothing wrong with the SPY. You just don't need SPY with VOO, with VOOV, with SCHG. You have so much overlap. You can simplify it. You can lower it down to one or two of them, at most two of them, depending on which stocks they're holding heavily. Now you got QQQ. Everybody talks about QQQ. 15.07% in the last 5 years. They had fantastic returns in the last three. And they are the Invesco QQQ Trust. They have a higher expense ratio. This is what I was talking about when you start getting a little crazier with the expense ratio. Mutual funds are also going to have a high expense ratio, which is why a lot of people steer clear of them. For passive investing, it's not great. They are not self-managed like these. They are managed by people, and those people make the calls. Sometimes they outperform, sometimes they do not. If you do look at a mutual fund, please make sure you're looking at their performance to the S&P 500. If you're not beating out what a ETF can do, then I would recommend not going with them because of that expense ratio. So when you look at the QQQs, once again, you are at the Mag 7. Plus, you got Palantir. Palantir is a great company. I think they still got some growth left in them. They did have massive growth in the last year, which is what is going to be sparking some of these returns here. It's still a great company, and all these companies are doing what they do best, which is earnings, profit, growth. It's fantastic. You just don't need all of these ETFs. So if you're already divested across multiple ETFs, please take a look at your top holdings and see the percentages and see where you might be able to cut one or two out, especially if you're taking a higher expense ratio on one over the other and the other is outperforming the higher expense ratio. Then you really need to do a little bit of research and a little bit of digging. So I like to diversify across a few of them. Once again, I'm a sucker for the Schwab, the dividend, and then you got the growth there. That's fantastic. So you might do dividend, growth, and then one of these S&P 500 ones, just so that way you're diversified. Yeah, you're going to have a couple overlaps, but they're not going to be massive. All right. So you guys hear me talk about Fidelity. I like Fidelity, and there's some things in here that you can do that I just absolutely adore. And it's ETF ETP screener. So right in here, if you can take a look at whatever you want, right? So you can go market cap, you can go active ETFs, digital assets, sector. Let's start with sector. So obviously technology is going to be the top holding in most of these S&P 500s. So you think health sector is going to be on the rise. Go ahead and click on health, and then you can find some that have more health care. So let's click on VHT. It's a Vanguard one. Vanguard's a proven company. They do awesome with the ETFs and the funds. You got a lower expense ratio. Your top holdings are Eli Lilly, AbbVie, Johnson & Johnson, United Health, Merck & Co. A lot of these names that most people actually know off the top of their head. Eli Lilly is sitting at 12.5% of this fund. And then we're going to come down here in the last 5 years, they were 10% less than the S&P 500. But you can look, their 1 year so far actually has been doing pretty well. So if you think the healthcare sector is on the rise, you can diversify and pick up all of these companies all in one ETF, which is just fantastic. This is what most people need to be doing. Trying to outperform the S&P 500 is very difficult. It takes a lot of research, and most people still fail even with that research. So when we look at market caps here, foreign large blend, small blend, mid cap, large blend, you can go mid cap, and mid cap is not going to hold any of those, the Mag 7. They're all large cap companies, right? So let's click on VO. I liked it because it was close to the other VOOs. Mid Cap Index Fund ETF. So you got Constellation Energy, New Mount Top, Robinhood right there. These are all mid cap. DoorDash, General Motors, still things that everybody kind of knows. Royal Caribbean. Great, great companies in here. And we can see where they fall out on the 5 year. They didn't do too hot comparatively in the 5 year. They're doing all right in the 1 year, the 3 year. Their life isn't that great. But when these companies move from mid cap to large cap, they have to be let go of this out of this ETF, right? Once again, they have rules to follow. So if they become a small cap because they get pushed down, or they become a large cap because they just have insane growth opportunities, then in reality, they are going to leave this ETF and they are going to go into these other ETFs that we already discussed. So do a little bit of research on your own before you go jumping into any of these ETFs. Just take a look at the expense ratio, take a look at what they're actually invested in. It's important for your diversification of your portfolio, the growth of your portfolio, and exactly what you want out of your investments, maybe. So if you got any kind of knowledge or liked anything in this video, please leave a like, subscribe, and stay in tune for the next one.